When it comes to investing, the idea is for everyone to make money. You are putting your money to work in the stock market in order to build generational wealth. However, every stock or ETF or index fund that you invest in isn't going to be green. I hate to say it. You're going to have plenty of stocks that you invest in over time that are going to be in the red for one reason or another. And maybe you're sitting on plenty of stocks that are in the red right now, and you're just hoping that they just get back to break even. Well, I'm here to tell you today that a little strategy called tax loss harvesting, you could get rid of those at pretty much a fraction of the cost because it's going to bring down your taxable income. So with that being said, in today's video, we're going to talk about a little strategy called tax loss harvesting. The professionals use it all the time, and I'm here to show you, the retail investor, how you can utilize this same exact strategy to save yourself thousands every year in taxes being paid. But before we jump in, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we jump in, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video talking about tax loss harvesting, a little old strategy that professional investors use every single year to bring down their taxable income. Well, you, the retail investor, can utilize this same exact strategy for yourself, saving yourself thousands of dollars. No one out there likes to pay taxes, so understanding the tax code can go a long way. When it comes to how long you've held a stock, that actually matters. If you've held a stock for longer than 12 months, that there is considered a long-term holding. If you've only held a stock for less than 12 months, that is a short-term holding. And when you go to sell that stock, if you have a gain in that position, if you sell a stock that you've held for longer than 12 months, that will be considered a long-term capital gain. But if you sell a stock that you have a gain in that you've held for less than 12 months, that there is a short-term capital gain. And how long you've held the stock will determine the tax rate that is applied to those gains. As such, if you've held a stock for less than 12 months, again, that's considered a short-term holding, and you sell it at a gain, so you're in the green, the tax rate that will be applied is your ordinary tax rate. Here's a look at the 2023 ordinary tax rates as of 2023. You could see the column for single, married filing jointly, married filing separately, as well as head of household. And they go from 10% all the way as high as 37%. So if you hold a stock for less than 12 months and your adjusted gross income is $100,000 if you're single, your gains are taxed at a 24% tax rate. The highest one can be taxed on a short-term capital gain standpoint is 37%. All right, now if we're looking to sell a stock that we've held for longer than 12 months, any of those gains will be taxed at a long-term capital gains rate. You could see 0%, 15%, and 20%. And it's all, again, determined on your taxable income. So if you're single, anything less than $44,625 in taxable income, that's a 0% tax bracket. Head of household, less than $59,750, 0% long-term capital gains. Married filing jointly, less than $89,250, 0% on any long-term capital gains tax. However, the majority of folks are going to sit in this 15% bracket. If you're single between, and you can see big gaps here, single with taxable income between $44,626 and $492,300, you're going to be taxed at a 15% rate. Head of household between $59,751 and taxable income of $523,050, you're going to have that 15% tax bracket. And then married filing jointly between taxable income of $89,251 all the way up to $553,850, you will be in that 15% tax bracket. Now for the highest earning individuals, if you're single, if you have a taxable income above $492,300, you're going to be hit with a 20% tax rate. Again, much less than the 37% that ordinary tax bracket and short-term capital gains would be applied. Head of household, anything above $523,050, and married filing jointly, anything above $553,850, you will be in the 20% long-term capital gains tax bracket. So as you can see there, the majority of folks are going to fall within the 15% tax bracket. But it's also much less and much more advantageous than looking at the ordinary tax brackets. We're talking about as high as 37%, where the highest you can go here for long-term capital gains is only 20%. for the highest earning individuals. Again, the majority are going to fall within the 15% rate. So that there tells us how much we're going to pay in taxes. And that's great, Mark. I clicked on this video to look at how I'm going to save on taxes. And that leads us into tax loss harvesting. I first wanted you to know how your taxes are calculated, but now we're going to jump into tax loss harvesting, which is going to show you how you can utilize this strategy to save thousands every single year on stocks that you might be in the red in. This strategy is all focused on lowering your tax bill, and the majority of investors that are out there utilize this strategy at the end of the year in Q4 as we get closer to closing out that taxable year. So now we're going to get to the idea of selling stocks that we might be in the red in. And maybe you've been holding on to these stocks for a little while now, saying, I just want them to get back to break even. Well, now you could have an excuse and a game plan, a calculated game plan, and have a reason to sell these stocks, because overall, they're going to lower your taxable income. The idea of tax loss harvesting is when an investor sells a position in which they're sitting on a loss. Maybe they no longer like the company, or maybe your thesis on why you originally invested changed, or maybe you just want to lower your tax bill. Selling a security at a loss can offset some of your long-term and short-term capital gains. Now, when you go to sell this stock that is in the red, again, it's going to matter. Have you held this stock for less than 12 months or more than 12 months? Long-term losses can offset those long-term capital gains. Short-term losses can offset short-term capital gains. Let's take a look at a simple example here to help you understand. Let's say we have 4 different positions right now: stock A, stock B, stock C, and stock D. Stock A we've held for 2 years and we are in the money by $22,000. We have a profit of $22,000. Stock B we bought just 3 months ago and have a $7,500 gain. Stock C we've held for 15 months, but we have a loss of $10,000 we're sitting in right now. And stock D we bought 5 months ago, but we're down $5,000. So as you can see, stock A and stock C are both long-term holdings. Stock B and stock D are both short-term holdings. So if we wanted to sell all of these stocks, selling stock A, let's first look at if we were to just sell stock A and stock B. If we were to just sell stock A and B, stock A would fall into the long-term capital gains category, meaning we would be taxed at a 15% rate. We would owe taxes of $3,300. That's $22,000 gain times a 15% tax rate. Selling stock B would fall into the short-term capital gains category, meaning we would be taxed at a 30% tax rate. That's a hypothetical income assumption to determine the tax rate. We would owe taxes of $2,250. That's a $7,500 gain times a 30% tax rate. In total, we would owe taxes of $5,550. However, everyone is on the search to lower their tax bill. So let's look at how we could utilize tax loss harvesting in this example by selling the stocks C and D, which are both at a loss right now, but they're going to lower our taxes. If we sold stock C, that would offset our $22,000 long-term capital gain by $10,000, resulting in our long-term capital gain now being only $12,000 by the end of the year. Our new long-term capital gains tax owed would be $1,800. If we sold stock D, which was a short-term holding, that would offset $5,000 of the $7,500 short-term capital gains we would owe, bringing our short-term capital gains down to $2,500. Our new short-term capital gains tax owed would be only $750. So now if we looked at our total taxes owed with tax loss harvesting, we are looking at a total of $2,550. Just right here, tax loss harvesting saved us $3,000 just in this simple example right here. Remember, the tax code first makes us combine like-minded holdings, so long-term capital gains with long-term capital losses. Net those out. Short-term capital gains with short-term capital losses. Net those out. Now, if you still have losses in either one or the other, short-term or long-term, then, and you've exhausted all of it, you can combine those together. So the short-term net number, the long-term net number can then be combined as well if there are some losses remaining. Now, let's say you're in a situation where you actually have net losses in both your short-term and your long-term. Number one, we probably had a bad year in the market, or we're doing something wrong when it comes to trading. However, you can roll, or you can apply $3,000 towards lowering your overall taxable income. So you can bring that down by $3,000, but let's say we had losses of $5,000. Well, $3,000 can bring down your total taxable income for that year, and you can roll the remaining $2,000 the following year. Selling a stock just to lower your tax bill shouldn't be the first priority that you have. But if you have a position in there where you're sitting on the red and just hoping that it gets back to break even because you really want to get rid of it and get it out of your portfolio, then consider tax loss harvesting. But if you're just selling it but still like it, well, then that can come back to burn you. So make sure it's not your first priority. But again, this position and this strategy here can save someone thousands. We did it right in our example, and professional investors do this every single year to lower their tax bill, and it's legal. So if you've enjoyed this video, then show me some love by hitting that like button down below. And again, subscribe to the channel if you haven't done so yet. And with that being said, Happy New Year, and we'll see you in the next video. Take care.